One of the true strengths of the dollar is not that people are long it. It's actually that people are short the dollar. The dollar is the one market where you can come in and borrow in size. Look at what's happening today. We're going to raise $85 billion for Google, or we just did like that. We're going to raise $80 billion for these IPOs in the tech space, SpaceX, like that. Try to do an $80 billion move in underwriting equities in any other currency. It's not going to happen.
Hello, everyone. It's really great to see you guys here. So we will be talking about the US dollar today. David will share macro perspective. He's a chief market strategist at Jefferies, and he will share some insights how investors should be positioned. And Brendan, he is a contributing author to the Financial Times, editor, and then he's the author of Almighty Dollar. He will tell us about historical perspective and how basically we got here. But David, I really want to start with you and talk about the recent price action, because we do see a sell-off across US stocks. We saw hotter than expected jobs report recently. People expect now a rate hike later this year. What is your take on this stock market reaction?
Well, it's great to be here. Thank you for hosting. Thanks, everybody, for joining. I'm just taken aback by the pictures of the three of us in front. We all look so different. Maybe
we do look different.
We should have a conversation about that, too, maybe. But
I need a more recent headshot
is
what's happening.
I think the stock market performance, as well as the economic performance of the last 3.5 months, is actually the most important takeaway from a global macro perspective on this year that we've seen to help you understand what's likely to happen as we go into the second half of the year. We've been hit with two very large shocks. First, we saw the energy complex rise about 50 to 70%, depending on where you want to look at it. $60 oil to $90 oil, give or take, sustained. And we went from pricing in 2 rate cuts to pricing in 1 rate hike. So on the demand side, we had a negative demand shock from a 100 basis point move in short rate expectations. On the supply side, we had a negative shock, a negative supply shock with the relative price of oil moving. Typically, shocks of that size tend to have negative consequences for both the economic data and financial markets. And since February 27th, when all of this has began, the stock market's done nothing but really go up. And today, I think, sits up about 8% or so for the year, a little bit off of the highs. I think the message, and I'll draw it from a counterfactual standpoint, is that there's an underlying strength to the guts of this US economy. There is a productivity story that's been brewing now for many years. That productivity story is rooted in things like AI and tech, but it's also in deregulation, pro-business policies, tax certainty, and the like. And all of that is propelling a narrative and a storyline in the US economy, which is extraordinarily positive. And it's a great time to be an owner of capital. The capital share of income has never been higher. It's been a rockier time to be a provider of labor. Labor share of income is going down. And we're seeing that in the no hire, no fire job market that's been in place now for a number of years, although maybe it's looking up a little bit. But I think we're learning about how strong the underlying guts of the US economy really is, because we just punched it twice and it basically said, I don't care, I'm still going.
Except for the past couple of days.
Look, the past couple of days notwithstanding, I don't know, Friday was a big day, 2.5%, 3%. We don't get so many of those, and we've wobbled since then. I'm not going to rest my hat on a couple of days of price action. I'm going to look at where we are year to date and what we've seen. And I think there's a lot more in that move than in what's happening recently. I know you want to ask other questions about kind of why we've seen that, so I don't want to jump in front of you.
Yeah,
but
so
if you want, I can go there, or you can bring
With all of that in mind, how actually you see the dollar moving from here, and what drives it? Because some people are saying this is a rate story. Some people are saying that the US stock market actually now more responsible for the dollar strength than some other factors. So how do you see that?
You know, I think overall what I'd say, Natalia, the dollar to me is strong. right now. I know we had a little bit of a weakening last year, and some people thought that was a major weakening. In the grand scheme of things, and the way I look at things over long horizons like the last 20 years, within the last 20 years, the euro was at 160. The pound was over 2 to the dollar. The Aussie was over 1 to the dollar. Dollar yen was back down closer to 100. The Korean won, all of these emerging market currencies. To me, the dollar sits in a relatively strong place. It's been stronger, but it sits in a relatively strong place, and I think it stems from policy that is restrictive, a Fed that has not got back to neutral,
yes.
And it stems from the fact that our productivity story is just better than the rest or the average global productivity story, and so there's a real rate support to the US that keeps dollars flowing in.
So you are bullish?
I am bullish risk assets, very bullish risk assets. I don't see rates staying up this high for much longer. I think there will be a debate between balance sheet and rate at the Fed coming under Warsh. And I think that should undermine a little bit of the support for the dollar as we move through this year and next year. But I don't think there's a big currency move coming. And I think the dollar sits in a very strong place. So I would be looking for some mean reversion. Dollar yen at 160, the Korean won at levels we haven't seen since the 98
yes.
crisis. There's some very important signs that the dollar sits in maybe slightly too strong a space, and an administration that really probably doesn't want a super strong dollar.
Yeah.
So when we talk about the dollar or any other currency, we tend to look at what's happening in the countries domestically. Brendan, I know you've been skeptical of the idea of this monetary sovereignty, basically that each country is responsible for what's happening with its own currency. Why do we need to think about it?
So I just finished writing a book about 500 years of the history of the dollar. We do not have to go back 500 years, but one of the things that stuck out to me is that we have this sort of challenge in the history of the dollar, which is that there's this assumption that we started a new country 250 years ago. With that new country comes the assumption of monetary sovereignty. We started a new currency. That's not really how it worked. What happened was the United States 250 years ago adopted an existing silver coin with a German name that came from a Spanish empire. We succumbed to an existing dollar zone when America was founded. The reason that's important to know is that it helps us analyze how currency is actually created now and how currencies spread. When David and I went to undergrad, we were taught in our macro 102 class that money came from the state, that it was inherently sovereign. The Fed made up money out of nowhere, and then it spread through the banks and to consumers. Now, that's a simplification. Every theory is a simplification, but that simplification, I think, is hurting us right now when we try to understand the dollar. What we actually know is money comes from banks. The Fed is there, it's a big bank, and it can control in some ways how banks lend or whether they lend. It can discourage them from lending. But dollar creation happens at the level of a bank balance sheet. When a bank makes a loan, it creates a brand new dollar. That's not an act of sovereignty. The United States is not doing that. Commercial bankers are doing that. So that helps us understand the global dollar system. Banks abroad do this as well, right? Your audience is going to know this as the eurodollar system. But anybody can create a dollar, and banks abroad create dollars as well. The reason this system works, the reason so many banks abroad create dollars, and again, that's in the same ballpark as American dollars. There are 14 trillion, according to the Bank for International Settlements, foreign-produced dollars in the world. There are only 19 trillion American-produced dollars in the world. They're comparable amounts. Is that the American system allows people abroad to make their own dollars, and then in many ways we support it.
I'm also curious what's been happening right now. Let's say if you look at this year or the past 2 years versus, 5 years ago, and what's been happening with the eurodollar system and other countries printing US dollars.
Yeah, I think we have to resist looking at the global dollar system as a referendum on America. When you look abroad, perceptions of American power have gone down. I don't know that that's necessarily had an effect on the dollar itself. The dollar is its own system, and we have to resist seeing a currency as just a reflection of a country. I think of the international dollar system as resting on a three-legged stool. One leg is American bank regulation and a vast pool of insured deposits. Nobody else in the world has a currency regime this broad where the deposits are insured. That's massive. Europe doesn't have that.
Yep.
The second one is just sort of a broad catch-all we'll call American institutions. Still pretty sound, under challenge, but I think there's still some basic trust in how America works. The last one is really important, which is the Federal Reserve swap lines. And this is a thing that the Federal Reserve does that it doesn't really talk about publicly in America because it's not that important to America. But they will lend, they will offer liquidity short-term to foreign central banks who can then offer it to their own commercial banks. It's these three things that support the dollar. And when we look at what happened over the last year, the dollar, again, is not a referendum on American behavior. It's a referendum on those three institutions that I just laid out, and they're still sound.
David, I'm just thinking, as we talk to many investors, many of them are saying, yes, we see this reversal in the US dollar. It's moving stronger. But considering everything that has been happening, geopolitical tensions, this rally in US stocks, the dollar should be actually higher. Would you agree with that? And if yes, what's holding it back?
So I do think part of the dollar story goes back to the trade story from last spring. And one of the pillars of the renegotiation of trading agreements was currency intervention or currency manipulation. And we saw the administration point at a few countries that they saw as keeping a weak currency, China being the obvious case, for competitiveness reason. And I still think underlying that story is a desire not to let your currency get too weak relative to the dollar. We see the Japanese intervening here at 160 in dollar yen. The Koreans have been intervening at 1550 in the Korean won. But away from those specifics, I don't know that I would say the dollar's doing something incongruous with the macroeconomic storyline. To me, the dollar has actually not been very volatile. The dollar has been in a broad range that I think people feel comfortable with. And the story for most investors, particularly those that focus in on a macro bias, has not been in currencies. It's really been in rates and equities.
Exactly.
So I think the upshot is that this is a quiet period in currencies, and there is somewhat of a desire to think about a weakening dollar only because you have an administration through its trade policies that is kind of focusing in on dollar strength as maybe a bad thing for competitiveness. But in general, it hasn't been pushed to an extreme. So currency has taken a backseat in many macro conversations that I have with investors. Doesn't mean it can't pop up soon. But I would like to add one thing to what Brendan said about the dollar. And I think this is really important for investors when they think about why the dollar does what it does in times of crisis or what really drives the dollar overall. Many of us think about it as this safe haven that people go to around the world because they don't trust their own banking system or their own financial regulators or their printing presses in other countries. One of the true strengths of the dollar is not that people are long it. It's actually that people are short the dollar. The dollar is the one market where you can come in and borrow in size. Look at what's happening today. We're going to raise $85 billion for Google, or we just did like that. We're going to raise $80 billion for these IPOs in the tech space, SpaceX, and then we've got more coming like that. Try to do an $80 billion move in underwriting equities in any other currency. It's not going to happen. Where does Saudi Aramco come to do its IPO? It's not doing it in Saudi riyals. So the reason that the dollar always strengthens in times of crisis is that balance sheets get hit and assets go down. Liabilities don't. Liabilities are largely denominated in dollars, and a way to get yourself square is either to raise your asset values, which is really hard to do, or lower your liabilities. How do you lower your liabilities? You buy dollars and you pay them off. Exactly. So everybody goes to delever by going to the dollar. They don't buy Bitcoin, they don't buy gold, they don't buy silver, they don't buy Saudi riyals, they don't buy Korean won. They buy dollars because that's what they're short. That's the real strength of the US economy. The real strength of the dollar rests in its capital markets and the depth of its capital markets. It's the only place where size can get done.
Let me just jump on real quick, because I think what David just said is really important. We have this story about currency movements that we learned in macroeconomics that says a currency should reflect the size of a country's trade. And then we look at the size of America's trade in goods, and we say it's impossible that the dollar should be so high. What we're missing there is exactly this process that David is talking about. America is insanely good at creating financial assets. If you want to create a financial asset, you come here. If you want to raise capital, you come here. There's an old joke among historians that the Roman Empire disappeared and they were left with a church. The English Empire disappeared and they were left with the Bank of England. There will always be American capital markets. People come here to raise money. And so that means that the dollar is actually, and I agree with David, correctly priced. It's not abnormally high, and it hasn't been for the last 30 years because Americans, the know-how is in creating financial assets.
I want to ask you about some technical forces, let's say, from overseas. Because when we saw this huge spike in energy prices, countries that import crude, mostly Asian countries, they had to sell dollar reserves in order to buy more crude. So when you look at global dollar reserves, how important is that, you think, for the strength or weakness of the US dollar? And why investors should pay attention to that?
So I think reserves are there to be used in a crisis. I think more broadly when we talk about dollar reserves held at other central banks, so this is a measure that we've been looking at that's been dropping over the last 10 years. When you look at that, a lot of what's going on there are two trends. The New York Liberty Street blog, New York Fed's Liberty Street blog has been really good on this. That are driving that. One of them is a sort of secular decision that Russia has made to pivot out of dollar assets and into gold. Yeah. The other is technology has made it a lot easier to hold smaller currencies. It used to be that it was just unpragmatic to hold anything other than a lot of treasuries. It's possible now to figure out how to hold things that are denominated in Swedish kroner, for example. That's another move that Barry Eichengreen has tracked. I really prefer to look at the measure, instead of looking at central bank reserves, to look at decisions that private commercial banks are making to produce their own dollar-denominated loans. That's not dropping. It has not dropped over the last 10 years. It's rising, in fact. That number is going up and to the right. Again, $14 trillion in offshore dollar loans is significant. And I think that bankers do that for a reason. It's not vibes. It's not because people like America, and then if they dislike America, they're going to crowd out of it. There are lots of technical reasons that David and I have gone through why it is that the dollar system works for a lot of people internationally. And I think we have to look at these private decisions to continue denominating loans in dollars as meaningful.
Yeah. David, by the way, what should happen for you in order for you to turn bearish on the dollar?
Bearish on the dollar or bearish on the stock markets?
On the dollar.
I mean, I think in general, I actually wouldn't have a dollar grinding higher view going into 2027. I would probably, along with my view that rates are likely to come down, the Fed's balance sheet is likely to come down, that we could see some dollar weakness come back into the marketplace. And I think there's also a lot of countries that are going to get pressured to not allow their currencies to weaken too much more, Japan, Korea, and others, mainly the Asians. But I would characterize myself as much more bullish on the risk asset space than I am on the currency space of the dollar. So I don't think I need much convincing. But I wouldn't have the dollar's not, I don't expect we're going to 160 in the euro or back to 200 in the pound. Maybe we could grind up to 125 in the euro, something like that.
But you said that the rates could go lower. Do you really expect that rates will go down, or because now people are?
I do.
Why?
Absolutely. Well, I think Kevin Warsh has made a very cogent argument about trading off interest rate levels for balance sheet levels, and I think that's going to become a far more important debate as we move forward, and the Fed narrows its footprint into the financial markets with this very large balance sheet. And the way you do that is tightening in on the balance sheet side and then easing back on the rate side to have a a more neutral outcome on the overall stance of monetary policy.
You know, some people are actually saying that even, let's say, if we do see a reopening of Strait of Hormuz, and then we see kind of easing on the inflationary side, it's not going to happen soon. It will take like months for inflation to go down. And that is why rates will stay elevated up until the rest of the year.
We had a pretty good core CPI today coming out only at 0.2. So that tells you that the underlying guts of inflation are not accelerating, that it really is the energy component that is driving the short-term rise up. So that's going to give the inflation hawks a bit of pause. And I think there's a lot of weakness in the interest rate sensitive sectors. These high rates have really been a horrible storyline for housing and other interest rate sensitive sectors. So the owner's equivalent rent and the other big components of core CPI could easily start to have a bigger turn lower, and that will start to catch the Fed's eye and the market's eye.
Interesting, yeah, because some people do say that maybe it is still too early. We will see inflationary pressures later on. We'll see. Brendan, what do you think would be one of the biggest or a few biggest risks for the dollar for a foreseeable future?
So I worry about the possible politicization of the Fed's swap lines. So the people in this room know how this works, but for the online audience, we can just explain briefly that the Fed will make short-term swaps, currency swaps with other central banks, and they then lend those for short-term liquidity to their own commercial banks. This has happened twice in the last 20 years, in 2008 and again 2020. The Fed does not make political decisions when it does that. It basically says, if you are a responsible central banker, we're gonna give you these swaps. There's a reason, there are yuan-denominated swap lines. And what we know from the countries that sort of decide or decide not to use these swap lines is that they're perceived to be intensely political. Mm-hmm. You get a yuan swap line only if you are willing to toe the line and do certain things that China wants you to do. The Treasury over the last 2 years has made clear that it has its own swap line separate from the Fed, the United States Treasury, that it is willing to tie political strings to short-term dollar loans. So that's different from the Fed. What I would worry about, to answer your question, is if we see at the Fed any possibility that those swap lines are conditional on anything else. I think you're going to start to see countries reevaluate their dollar holdings and reevaluate the resilience of the dollar system, because one of the things that make the dollar system work is this absolute bedrock knowledge that the Fed will jump in a crisis and support everybody else's dollars all over the world. There is some indication, based on Kevin Warsh's testimony after his nomination, that he's willing to think about international policies that are coordinated with the Treasury and the White House. We don't know what that'll look like. We don't even have any evidence that it's going to happen. But I think that's now a slight worry that I have, that the swap lines from the Fed could become politicized. I really think that would change the dollar system.
I think that's a really, really important point. And my guess is that we're going to move away from the Fed deciding on swap lines. The Treasury will be the point for all swap lines. They will be politicized. And there will be a picking of winners and losers in crisis times. Those who are kind of on Team USA will get dollars, and those who are not on Team USA will not get dollars. Mm-hmm. Yeah. And we could see some very ugly behavior in certain markets when the tide goes out and that asset liability story where deleveraging needs to happen doesn't get the benefit of easy dollars coming into a central bank in, say, a Middle East country that wasn't cooperative with the US, or an Asian country that wasn't cooperative with the US. That, I think, is going to happen, which means emerging market traders are really going to have to evaluate the country's relations with the US and how those are evolving and how those trade negotiations are going. But it's a really important point you bring up.
I mean, I'm somewhat chastened to see you even more alarmed by that than I am. I have to say, the problem with that tool, if they decide to employ it as diplomacy and not just sort of global financial rescue, is that you can use it once and then never again. So I think David's absolutely right. When he describes what the crisis will look like if these swap lines get politicized, I agree. That's a very good description of how it will go down. After that crisis, I do think we would see a move away from dollar-denominated loans. If you cannot trust the Fed to help you and be the lender of last resort, and this is a financial role that we've known is necessary since the 1840s. Right? We know that somebody has to be the liquidity provider of last resort. And so I worry that if they see that the Fed's not going to do that, that they'll change their behavior.
I really want to talk about positioning because we definitely have investors among our audience. David, what do you think, like if you were deploying fresh capital right now, how would you allocate this capital across like asset classes, maybe specific sectors or globally?
Yeah, I'm a macro guy, so sectors and individual companies aren't so much my gig, but I'm very optimistic on the outlook for US capital markets. I think earnings, profits, returns on capital, my excitement level there is, and I'm a pretty bullish guy by historical standards. People know me as an optimist. I think I had 4 producers at CNBC call me Friday afternoon to try to book me on Monday. After the 2% plus down move. And that's kind of been my history as a contributor at CNBC, is whenever it's messy, they call Zervos to try to talk people off the ledge a little bit. I'm so optimistic on that capital story. And I think the US still offers one of the greatest places to deploy that capital. Would I consider Japan? Would I consider Korea? Would I consider other parts of the productivity story in hardware growth? Yes, I would. I think Europe offers you very little and is probably the least likely to benefit from anything AI, largely because their companies have unflexible labor markets, and to be able to really benefit from AI, you have to be able to move labor swiftly and aggressively out of certain sectors that are being creatively destroyed by the technological advance. Europe's not that. Asia's actually pretty well disposed to that because the demographics are just so negative for their labor markets. We're disposed to it because we don't really mind hiring and firing lots of people and moving them around. So I think we're in a great spot. I worry a little bit about the politics of technological advance and how November plays out, and whether the anti-data center movement picks up, and whether things like what's happened here in New York with Mamdani, or what happened in Virginia and New Jersey's governor races kind of slow down this productivity growth story. But overall, I'm extremely optimistic. And I add that with my rate views, I'm even more optimistic.
We have 40 seconds left, but I have to ask you, because tomorrow we will have the biggest IPO of all times, which could potentially be followed by OpenAI and Anthropic. Some people are saying that could actually create a headwind for the stock market because people are now exiting positions to go into SpaceX. Like, will that affect the US stock market story anyhow?
I guess that's for me.
I'm a historian. I can't tell you where we're going.
I got 20 seconds. I think it's such a bullish signal that these companies are coming in and wanting to invest with their own equity this much in this technological advance. It shows you how excited they are for the productivity gains that they see and the disinflationary outcome that those productivity gains will bring for the future. I am even more excited when I see a SpaceX, Anthropic, and OpenAI IPO, and how excited these companies are to take us to the next level in what is likely an industrial revolution on par with things like railroads and the advent of energy sources like petroleum.
Thank you so much. It was a pleasure. Thank you, guys.
Always. Thank you.